The last thing I want to touch on, this is the basics of accounting. This is a very, very, very simple equation. Anybody with some basic accounting knowledge should be able to fill this out. I wanted to see where y'all were at. So I gave you a word bank, and I wanted to see if you could kind of fill in these blanks. Y'all have any idea? Jonathan, I know you've had some accounting. Go for it, man.
Assets equals revenue. No. Really? Hold on. Stockholders' equity plus liability. And then
Got it.
stockholders' equity equals retained earnings plus common stock.
Yep, keep going, man. You're killing it.
And then common stock is, well, retained earnings is revenues minus expenses.
Yep.
Isn't it? Where's
Last one.
Oh, dividends.
Yeah, you got it, man. Killed it. I'll bring you some candy or something. Bring it in next time. But what he's talking about is the basic accounting equation. So it's your assets must equal your liabilities and stockholders' equity. And then the stockholders' equity is broken down into two parts. Retained earnings, this is basically where the company makes money. It goes into this account. So we'll talk about temporary accounts and basically how it goes into there. Your common stock is what me and you buy whenever we own a stock. So that's going to go into your common stock. So basically all the company's assets have to equal its debts that they've borrowed, and then its stockholders' equity, plus what they've earned, plus what investors have actually given the company. So I don't know if you heard about Spotify's IPO, right? It was the third largest. It hit, what was it, $27 billion. That $27 billion is going to be in common stock. Then they're also going to have some retained earnings, which are made up of revenues minus expenses minus dividends. Any questions on this? Like I said, 2 weeks from now, I'm going to go a lot more into the accounting aspects of it. But I just wanted to give you all an overview on how you can do fundamental analysis and show you that it's more broad than just looking at accounting numbers. There's a lot more to look at.
So when we say a company has large, big assets, it also includes their liabilities then, right?
No, well, what it's saying is that for every asset, it either is financed by debt, which would be your liabilities, or earnings that you've made in the past, or somebody giving you money because they own part of the company. So that's what this equation is trying to say.
Okay, the liabilities are also used toward company's growth, right?
Yes, so it's like if you went to a bank and you wanted to borrow $100,000.
Does this include loans?
Yes, that would go into liabilities.
Yeah.
So if you were trying to start a restaurant business, since we were just talking about that, and a bank granted you $100,000, you'd have to pay back those $100,000. So the $100,000 would go right here, and then you'd have $100,000 in your cash as an asset. So it always has to be balanced out. Does that make sense?
Mm-hmm.
Okay, and like I said, I'll expand a lot more on this in 2 weeks. Any other questions that you'll have?
So a company borrowing $10 million from somebody would have more asset than let's say a company, they have same equity, but one borrows $10 million from somebody, they have more assets, although they owe more.
Right, but the thing is exactly that they owe more. So relatively, they would be exactly the same. And you don't always want a great debt. So for instance, I would rather have a company that has maybe $1 million, $500,000, and $500,000 of retained earnings versus a company that just has $1 million and then owes $1 million. So we'll get a lot more into that in 2 weeks from now, and I can answer those questions a little bit better for you.